Hey everyone, it's Ryan here. In today's video, I want to talk about one of the things that I think every property investor, real estate investor should get right as soon as possible. So there's a book I had read called Profit First. This book I would highly recommend to anybody getting interested in starting a business of having to do with anything, honestly, because it helps you so much on the accounting side of things. But in this book, the author lays out basically creating a set of accounts that are designed in a way that you will always pay yourself some sort of profit. And if you don't, then you know as clear as day that the business is not profitable and what you need to change to make it profitable. So I wanted to go over in this video just the bank that I use right now to use the Profit First system. So right now I use Capital One because they allow me to set up multiple accounts. Now, as you can see, there's nothing in any of these accounts right now. This is just a proof of concept to show you because the way that I handle it right now, with the way the business works right now, I do it in this way. So with the income account, I don't exactly have anything there because that's where all the funds come in and then I distribute them to other accounts. So I have these target percentages. So profit's always going to be 1%, which I'd like to raise over time, but I always keep it at least at 1%. And then there's owner's comp, which is owner's compensation. So you would expect to be able to give yourself distributions out of the profit in owner's compensation. And then you also have tax, always withhold tax. I always have that set at 15% because don't want to run into issues with the IRS. And then 68% for OPEX. Now, this percentage isn't quite accurate, and the TAP is actually the target percentage that I would like to get to, which I believe is 19 here. And then like for tax, for tax, the target percentage is 15. That's understandable because I always want to keep it at 15 because generally 15% is what taxes work out to. And then insurance is 15 as well. You want to have insurance depending on what business you're in. Generally, insurance is going to be involved. So one thing I wanted to show you is these are all my short-term accounts. What this all moves into is long-term accounts. That's why there's no funds in these accounts right now. I hold any of the funds in what I wanted to roll into now using high yield savings accounts or high yield checking accounts for long-term holds on funds. So I want to give you an example. For a property, you generally want to have, at least the rule of thumb I've found from contacting people on BiggerPockets, is for duplexes, you generally want to have at least 20,000 on hand per house. So that takes care of any of the issues that come up. So give you an example, 20,000 times 0.10%, because 0.10 is the best yield you're going to get from an Ally interest checking account. That is their yield right now. So you're getting $20 a year off of that. Well, let's change that up. And right now I'm using Wealthfront, for example, for holding operating expense funds that I need to use over a long period of time. Just holding those funds in a high yield savings account that is as movable, as easily usable as a checking account. Now, you are limited by withdrawals and stuff like that, but a lot of my expenses, all my expenses, I actually carry through credit cards so I can just pay off the balance using an external account. So the accounting side of things works for me right now. And I'm not saying this system will work for everybody, but just looking at this return right here, $910 versus $20 a year. Say it costs you $100 a month to pay property management to take care of your property. That's $1,200 a year. Right here, just by holding the funds, just by holding your operating expenses in a different account, you've almost covered your property management fees. Simple as that. People will use other methods as well. Some people will use like CD ladders. Some people use I-bonds. Some people will mess with buying different funds and stuff, holding their operating expense funds in all these different funds. But to me, I knew that right now I needed those funds to be ready and accessible. I didn't want to have to wait on selling. And right now this worked best for me. In the current environment, we're getting really, really good interest rate yields. And so that's why I'm choosing to go the way I do. Maybe this way is not the best way of doing it. If you find a better way of doing it, feel free to let me know in the comments section. But hopefully this helps somebody on their bookkeeping side of things in being able to give themselves a little bit of extra padding. I mean, $20,000 is not a small amount of money. And I know that my operating expense account isn't there yet. But just thinking long term, that's a really, really good option to get a little bit of free yield and cover your expenses through just holding funds. Hope you enjoyed this video, and I'll see you guys in the next one.